Hey, my name's Amanda Winalda. I'm executive attorney at Anderson Advisors, and we're at day one of our live tax and asset protection event in beautiful San Diego. I'm joined by Eric Oliver. Eric, how are you?
Good. How are you?
I'm excellent. And Eric works at Cost Segregation Authority. Tell us a little bit about Cost Seg.
Yeah, so we work with investors and CPAs across the country reducing tax liability through cost segregation studies. So, cost segregation really is just accelerated depreciation on your real estate assets.
So, those are a lot of big words with a lot of syllables. And if you're not in real estate investing, they may sound foreign. So, what is depreciation?
Yeah, so depreciation, when you buy an asset, the IRS or the government allows you to depreciate that over time. So, it's a non cash expense that comes off of your taxable income. And so residential units get depreciated over 27 and a half years, and commercial units get depreciated over 39 years. Well, I'm not going to keep my property for 27 and a half or 39 years. So I want to take that depreciation at a faster rate. So we go into that asset or go into that, let's call it a single family rental, and we will, just as our name implies, segregate the cost of that rental into different buckets per se or asset classes. So for example, when you buy a rental, you buy not just the land and the walls, but you also buy some carpet. You buy some appliances, some ceiling fans, some garbage disposals, a driveway. All those things I mentioned, the IRS allows us to depreciate at a faster rate. And so we go in, put values to those, and then our deliverable back to you is a revised depreciation schedule, which allows you and your tax preparer to maximize those deductions and take them at a faster rate.
So give us an example. If we're maximizing deductions, how much can on a single family residence, how much are we looking to accelerate that depreciation? Is there a percentage or something I can expect?
That's a good question. So we usually segregate around 30%. So let's make the math easy. Say you buy $1 million asset, 30% of that is going to be 300,000. So there's $300,000 worth of stuff in that building that we can pull forward and segregate at a faster rate. And those categories that we usually pull it forward into are either 5, 7, or 15-year assets. And then there's something called bonus depreciation, which kind of puts cost segregation on steroids and allows you to depreciate that at even a faster rate. Bonus currently is at 60%. There's a bill that was presented to Congress and it passed the House almost unanimously. It got caught up in the Senate and they kind of killed it. Granted, we're in a presidential election year. And so I think what's going to happen is after the presidential election, I think Congress will get back together, hopefully, and put together a comprehensive tax bill that will hopefully pass next year that will extend 100% bonus, but currently we're in a 60% bonus period right now.
How many people have asked you what is the percentage of that bill being passed? Because a lot of people ask me that question.
That is a very common question. Here's my take. I think it's going to get passed because whether they tell you this or not, almost everyone in Washington owns real estate. And so whether they're Republicans or Democrats, they want to get this passed. Um, the bill is also tied to the child tax credits. So the Democrats are going to get their child tax credits. The Republicans are going to get their bonus depreciation. Everyone's going to be happy. They're going to agree on it. They're going to pass it. Fingers crossed. I think it's probably about a 90% chance it gets passed early next year.
I think that's true too. It's a trade-off, right?
It
Okay.
is.
So how much we've gone over how much you can save on a single family rental. What about commercial property? And when you say commercial 39 years, is that commercial? Are we considering like 4 units or more? What are we considering? A warehouse? What's a commercial and how much can I accelerate on that?
Yeah, so commercial in the tax world, commercial is, well, residential is anywhere where somebody lives. So whether it's a 350 unit apartment building, in the real estate world, that's considered commercial, but for the tax purposes, that's considered residential. So commercial is anywhere that's basically open for business. So your office building, medical space, retail, restaurants, those are all considered commercial. Depending on the type of asset, it can range anywhere from 20% segregation on, like, let's say a big empty warehouse where there's not a lot of stuff in it, to a car wash where when you buy a car wash, all you're buying is land improvements like curbs, gutters, asphalt, concrete, and you're buying equipment. You're not really buying an enclosed building. And so on car washes, we can get sometimes up to almost 100% of that purchase price minus the land because land is non depreciable, but 100% of that building value we can oftentimes segregate. So it just depends on the type of assets. Some are better than others, but even your big empty warehouses, we're still segregating about 20% of that into shorter asset lives.
And so when is the good time to do a cost segregation? Maybe I've just bought my property, maybe I've owned it for 15 years already. How am I timing this as an investor?
So you want to use these deductions to manage your tax brackets. And that's one of the beautiful things with cost segregation is you can kind of pick and choose when you utilize these deductions. So just because I bought a property this year doesn't mean I have to do the cost seg study this year. I can take my standard deduction and then maybe next year when I have high income or I sell my business and I have a lot of capital gains, maybe that's the year that I pull out my cost segregation card. I say, hey, I want to play this card this year. So you don't have to use it you don't have to do cost segregation in the year you buy the asset. You just want to use it to manage your tax brackets. And so we'll always get the tax preparer or the tax advisor involved early to say, hey, this building can generate this much deduction. When is it the best time for the client to utilize those deductions? Is it this year? And maybe it's not. Maybe they're in a low income year and they don't have a lot of income. Then we just keep it in our pocket. We play that card next year.
It's a true planning
Yes.
opportunity, not just take it right now because you've heard of it. You really want to work with a firm that understands how to maximize this. And then this sounds great. I feel like I'm going to save a lot of money, but it also sounds like a lot of work for me. Is it a lot of work for me?
It's not a lot of work for you. So basically, if you think your property is a candidate for cost seg, which by the way, any revenue generating property with a depreciable basis over 200,000 is probably worth looking at. It's not a lot of work for you. We'll do a free benefit analysis. All we need is the purchase price, the address, and the purchase date. So pretty easy to get us. We'll get you a benefit analysis. You'll share that with your tax preparer. If you decide to move forward, the IRS does require us to do a site visit. So we will schedule a site visit. One of the great things that came out of COVID is we're doing a lot of these site visits virtually now versus having to send our staff all over the country. So for some of the smaller assets, we can do it virtually. We set up a video conferencing app. You walk around the property with your smartphone. We ask, hey, show us the flooring in the kitchen, show us the electrical panels. There's certain things we need to see to do the study. Once you've done that, your work is done. And then we'll go ahead, it takes us about 10 or 14 days to put together the final report. We're going to share that report with you and your tax preparer. Your tax preparer is going to look through the report. Honestly, they're going to skip the first 49 pages. They're going to go to the last page, which is the revised depreciation schedule. They're going to upload that into their tax software, and that's how you'll realize the deductions.
We still appreciate those first 49 pages. We
Those
appreciate all
49
that work.
pages are necessary. They're not that exciting to read. So that's all the backup documentation. Should you ever find yourself in an audit, those first 49 pages tell the IRS why we're doing what we're doing, the case law behind it, and has all the measurements and pictures and everything to back it up.
Oh, that's the key when doing tax planning and tax strategies is document, document, document.
Yes, that's right.
The key. All right. So, how do people get in touch with you? How do we get this process started?
So you can actually go to Anderson's website. There is it's www.andersonadvisors forward slash well hold on www.com/CSA. If you go to that website, there's a form that you give us your name, your property information, and we'll create that benefit analysis. You can also go to our website, which is just www.costsegaauthority.com, and that form is also on that page as well. But that's the best way to get a hold of us.
And that's great. Remember that benefit analysis is completely free, no
Yeah.
obligation to move forward.
Correct. Yeah, we want to run that because we don't ever want to engage somebody if they're not going to save significant tax dollars. So let us run that analysis. Let's share it with your tax preparer. Let's make sure that we're all on the same page. Make sure you're going to have significant tax savings. And if so, then we'll move forward.
All right. Thanks so much, Eric.
You're welcome. Thanks for having me.